Something violent just happened in the silver market, and almost nobody noticed until it was already over. In a matter of moments, trillions in paper value evaporated like it had never existed. Prices didn't just fall, they collapsed with a speed that felt unnatural, like the floor had been pulled out from under the entire system. Traders stared at screens refreshing again and again, hoping it was a glitch. But it wasn't a glitch, it was a shockwave. Behind the scenes, a cascade of forced selling, margin calls, algorithmic triggers created a chain reaction that fed on itself. By the time retail investors even heard whispers of trouble, the damage was already done. And here's the most unsettling part. This wasn't the first time silver has done this. History shows that when silver moves, it doesn't walk, it stampedes. If you want to understand where this market could go next, you need to understand how something this massive can happen without warning. Because the same conditions may still be in place right now. Before we go deeper, if you want clear, calm breakdowns of financial events that others either ignore or oversimplify, consider subscribing to the Gray Ledger. And if you find this video useful, a quick like helps more than you might think. Silver has always lived in a strange space between a precious metal and an industrial commodity. It is money, but also material used in electronics, solar panels, medicine, and thousands of everyday products. That dual identity makes it uniquely vulnerable. When fear hits financial markets, investors rush toward silver. But when economic panic hits industry, demand can vanish just as quickly. During the crash, both forces collided at the same time. Investment demand weakened, while leveraged positions began to unwind violently. Large institutional traders often operate with borrowed money to amplify returns. That leverage works beautifully on the way up, but it becomes a trapdoor on the way down. As prices slipped, brokers demanded more collateral to cover losses. When traders couldn't provide it fast enough, their positions were liquidated automatically. Those forced sales pushed prices even lower, triggering more margin calls, which triggered more selling. It became a self-reinforcing downward spiral with no natural break. Meanwhile, high-frequency trading algorithms detected the momentum and accelerated it. Machines don't hesitate, don't panic, and don't wait for confirmation. They just execute. Liquidity, which normally cushions price moves, suddenly vanished. Buyers stepped back, unwilling to catch what looked like a falling knife. In thin conditions, even relatively small sell orders can move the market dramatically. But this time, the orders weren't small. Massive blocks of paper, silver, futures contracts, representing metal that may not even physically exist, flooded the exchanges. The volume dwarfed normal trading activity. To retail investors watching price charts, it looked like chaos. To insiders, it looked disturbingly familiar. Silver has a long history of explosive booms followed by brutal crashes. Each time the narrative changes, but the mechanics often stay the same. What makes this event different is the scale. Some analysts estimate that up to $1.7 trillion in notional value was wiped out across derivatives, funds, and related assets. Not all of that was real money, of course. Much of it existed only on paper, leveraged bets stacked on top of other leveraged bets. But when those structures collapse, the financial shock can spill into real markets very quickly. Losses force funds to sell other assets to raise cash, spreading stress across the system. For everyday investors, the crash seemed to come out of nowhere. There was no countdown, no headline warning, no official alarm bell. Yet in hindsight, the warning signs were there, hidden in volatility spikes, unusual options activity, and subtle shifts in liquidity. The problem is that most people don't know where to look, or what those signals mean. And that raises a deeper question. Was this truly unpredictable, or simply ignored until it was too late? History suggests that silver crashes rarely come out of a clear blue sky. They tend to build quietly, almost invisibly, while attention is focused somewhere else. In the months leading up to the collapse, volatility in the silver market had been creeping higher. Not explosive, not dramatic, just enough to suggest that something underneath was shifting. At the same time, speculative positioning was becoming increasingly crowded. Too many traders were leaning in the same direction, expecting prices to keep rising. Crowded trades are dangerous because they rely on the assumption that everyone can exit safely. In reality, exits are narrow doors, and panic turns them into bottlenecks. When the first wave of selling began, it didn't look catastrophic. It looked like a routine pullback after a strong run. But leveraged players don't have the luxury of waiting things out. Small losses can quickly become existential threats when borrowed money is involved. So the selling accelerated not because everyone suddenly lost faith, but because many had no choice. Survival, not strategy, became the priority. Another overlooked factor was the strength of the US dollar during that period. Silver, like most commodities, often moves inversely to the dollar. As the dollar strengthened, pressure built on metal prices. For global buyers using other currencies, silver suddenly became more expensive overnight. Industrial demand was also facing uncertainty. Slowing manufacturing data hinted that factories might soon need less raw material. That combination, weaker demand expectations, and a stronger currency created a fragile backdrop. All it needed was a spark. Some analysts point to large institutional repositioning as that spark. When major funds adjust allocations, the volumes involved can dwarf retail activity. These moves are not announced in advance. By the time filings or reports reveal them, the market has already reacted.
Meanwhile,
retail investors were largely focused on long-term bullish narratives. Stories about shortages, green energy demand, and monetary instability dominated online discussions. Those themes may still be valid over decades, but markets move on shorter timeframes. In the short run, liquidity and positioning matter more than fundamentals. There was also a psychological trap at play. After previous dips had quickly reversed, many traders assumed this one would too. Buying the dip works until it doesn't, when a decline turns into a cascade. Dip buyers can become additional forced sellers. Social media amplified the confusion. Conflicting claims spread rapidly, ranging from manipulation theories to rumors of exchange failures. While some concerns had kernels of truth, the noise made it harder to see the real driver, a classic liquidity event. When everyone needs cash at the same time, prices fall until buyers return. And buyers were scarce, not because silver suddenly became worthless, but because uncertainty makes capital cautious. Nobody wants to step in front of a runaway train. Even large physical dealers reported unusual behavior. Demand for actual coins and bars surged in some areas while paper prices were falling sharply. This disconnect between physical demand and paper pricing has appeared before in precious metal history. It highlights how futures markets can diverge from real-world supply for periods of time. For newcomers, this felt like a paradox. How could something be in high demand yet dropping in price? The answer lies in market structure. Futures markets set the global reference price, even though most contracts are settled in cash rather than metal. So when leveraged paper positions unwind, the price can fall regardless of physical buying. In extreme moments, financial flows overpower fundamentals. What retail investors missed was not a single headline event, but a buildup of pressure across multiple fronts. Like a fault line accumulating stress, it looked stable right up until it snapped. What makes silver especially prone to violent swings is how small the market actually is compared to other major assets. It takes far less capital to move silver than it does to move bonds, equities, or even gold. That smaller size makes it easier for large players to dominate short-term price action. When they rush in or out, the wake they leave behind can feel like a tsunami to everyone else. Another hidden accelerant is derivatives. Futures, options, swaps, layers of financial instruments, built on top of the underlying metal, multiply the impact of every move. Each contract represents silver that may never be delivered, yet the price of those contracts dictates the global benchmark. In effect, perception can outweigh physical reality. During the crash, open interest, the total number of outstanding contracts was unusually high. That meant a lot of bets were stacked on the table at the same time. High open interest combined with falling prices is dangerous. It signals that many traders are trapped on the wrong side of the move. As losses mount, some attempt to hold on, hoping for a rebound. Others are forced out immediately by risk controls. This creates staggered waves of selling rather than a single event. Just when it seems like the worst is over, another wave hits. Veteran traders sometimes call this a liquidation cascade. It's not a single explosion, but a chain of detonations moving through the system. Liquidity providers, who normally step in to stabilize markets, often pull back during extreme volatility. Without them, spreads widen and price gaps become more common. You might see silver drop not in smooth declines, but in sudden air pockets where price jumps from one level to another. Those gaps reflect the absence of buyers in between. For retail investors using stop-loss orders, this can be devastating. Orders meant to limit losses can execute far below the intended level when markets move too fast. Meanwhile, long-term holders watching from the sidelines face a different challenge: psychological pressure. Seeing months or years of gains evaporate in hours can trigger panic decisions. Fear compresses time. What would normally be a thoughtful choice becomes an urgent reaction just to stop the emotional pain. Some sell simply to regain a sense of control, others freeze, unable to act at all. Institutional players, however, often operate on predefined rules. Their models dictate when to reduce exposure, regardless of sentiment. When many funds use similar models, they can all head for the exit simultaneously. What looks like independent decisions becomes synchronized behavior. There is also the cross-asset effect. Losses in one market can force selling in another as investors rebalance portfolios or meet redemptions. So a crisis that begins in silver doesn't necessarily stay in silver. It can ripple outward into mining stocks, commodities, and even unrelated sectors. At the peak of the collapse, correlations across markets briefly spiked. Assets that normally move independently started falling together. That's often a sign of systemic stress rather than a problem unique to one commodity. Cash becomes king, and everything else becomes a source of liquidity. Yet paradoxically, these same moments can plant the seeds for powerful rebounds. Once forced selling exhausts itself, supply dries up just as suddenly as it appeared. Buyers who were waiting on the sidelines begin to step back in, attracted by lower prices. What looked like endless downside can reverse with surprising speed. But timing that shift is notoriously difficult. Markets rarely ring a bell to signal that the bottom is in. For retail investors who sold near the lows, the rebound can feel like salt in the wound. For those who held on, it can feel like vindication, even if the emotional toll was severe. And this cycle of panic, capitulation, and recovery is not unique to silver. It's a recurring pattern throughout financial history. What is unique is how quietly it can begin, and how violently it can unfold once momentum takes over. By the time it becomes headline news, the opportunity to react rationally may already be gone. In the aftermath, analysts and commentators scramble to assign a single cause, but complex events rarely have simple explanations. The truth is usually a web of interconnected forces that only becomes visible when you look backward. Some blame leverage, others point to algorithms, currency, strength, or institutional repositioning. Each explanation captures a piece of the puzzle, but none tell the whole story alone. What matters more for everyday investors is understanding that markets are systems, not straight lines. Stress in one corner can propagate rapidly through hidden channels. This is why crashes often feel like betrayals. It's the narrative that seemed solid yesterday dissolves overnight, replaced by a completely different reality. Yet historically, extreme moves in silver have often marked turning points rather than permanent declines. After severe sell-offs, the metal has repeatedly staged dramatic recoveries. That doesn't guarantee a repeat this time, but it reminds us that panic conditions are rarely stable. Fear burns hot, then eventually exhausts itself. Long-term participants often focus less on predicting the exact bottom and more on managing risk, so they can survive the storm. Survival in markets is an underrated strategy. Diversification, position sizing, and liquidity buffers may sound boring compared to bold predictions, but they are what separate endurance from ruin. The investors still standing after a crash are the ones who prepared for uncertainty. Another lesson is humility. No model, analyst, or influencer consistently foresees events of this magnitude. Even professionals with decades of experience can be blindsided when conditions align in unexpected ways. Markets have a way of punishing overconfidence. For viewers of the Gray Ledger, the goal isn't to promote fear or hype, but clarity. Understanding the mechanics behind dramatic events can reduce the chance of reacting purely on emotion. When you know that cascades, margin calls, and liquidity vacuums are part of the system, the chaos starts to look less mysterious. It becomes something to navigate rather than something to panic about. Still, one unsettling question remains: if a shock of this scale could happen once without warning, could it happen again? The honest answer is yes. The underlying structures that allowed the collapse, leverage, derivatives, automated trading, global interconnectedness, are still very much in place. In some cases, they are larger than ever. That doesn't mean another crash is imminent, but it does mean the potential energy exists. Markets store stress the way tectonic plates store pressure. Most of the time, nothing happens. Then suddenly, everything happens at once. For retail investors, the most valuable takeaway may be awareness, not predicting the exact moment of the next move, but recognizing the conditions that make extreme outcomes possible. Watch for crowded trades, rising volatility, tightening liquidity, and excessive leverage. These are the warning tremors that often precede larger shifts. And perhaps most importantly, remember that price is not the same as value. In panic conditions, price reflects urgency, not necessarily fundamentals. If this breakdown helped you see the silver market in a new light, share this video with someone who still thinks crashes only happen because of a single headline. Conversations like these spread awareness faster than any algorithm. I'd also like to hear your perspective. Do you think this collapse was a one-time event, or a preview of something bigger building beneath the surface? Leave your thoughts in the comments below. Your insights help shape future investigations here on the Gray Ledger, and they often highlight angles that mainstream coverage overlooks. This community works best when it's a dialogue, not a monologue. Because in a world where trillions can vanish in silence, the most dangerous position is believing that someone else will warn you in time.